Imagine a surgeon, right? Like, they're scrubbing in for an operation on a Wednesday morning, preparing to make this massive, life-altering incision.
Okay. High stakes.
Very high stakes.
Mm.
But the crucial blood test, the one piece of diagnostic data they really need to know if the patient can actually survive the surgery. Well, that doesn't arrive from the lab until Thursday.
Oh, wow. Yeah, you'd probably want to stop the surgery, right?
Right. I mean, any sane person would pause. But in the world of macroeconomics, they just keep cutting.
Yeah, it really is the ultimate blind spot. You're forced to operate on the entire economy using information that is either, delayed, incomplete, or in some cases already obsolete.
And that blind spot is exactly what we are navigating today. We're doing a deep dive into an economic preview from our sources titled, What to Expect from Thursday's Report on Inflation.
Which is a big one.
A huge one. This Thursday, the Bureau of Economic Analysis is dropping a highly anticipated report on the PCE, which is the Personal Consumption Expenditures Index. So we are going to look at the upcoming data, how the Federal Reserve is reacting to it, and the, frankly, surprising forces that are driving the prices of literally everything you buy. Okay, let's unpack this.
Yeah.
Because this isn't just some dry economics lesson. This is a look at how global oil choke points and the race for artificial intelligence are colliding directly with your wallet.
Yeah, it's wild. And to set the stage here, we really have to establish why Thursday's PCE report is so vital. Like, you often hear about the CPI on the news, the Consumer Price Index.
Yeah, CPI is everywhere.
Right, and CPI tracks the cost of a fixed basket of goods. But the Federal Reserve actually prefers the PCE. The PCE is their absolute favorite metric because it's dynamic.
What do you mean by dynamic?
So if the price of beef skyrockets,
Yeah.
right, and you start buying chicken instead because it's cheaper, the PCE actually adjusts for that substitution.
Oh, I see.
Yeah, it captures what people are actually spending their money on, making it the Fed's primary compass for navigating inflation.
But here is the massive logistical contradiction I mentioned with that surgeon analogy earlier. Thursday's report is expected to show that inflation was decelerating in June.
Decelerating, yeah.
Because economists, this is from a survey by Dow Jones Newswires and the Wall Street Journal, they are predicting that headline consumer prices rose 3.7% over the 12 months ending in June.
Which is actually a notable drop, because in May, we saw a 4.1% annual increase. So on paper, moving down to 3.7%, that looks like real progress. It suggests the inflation fever might finally be breaking.
Wait, okay, but if the fever's breaking, then why is the Federal Reserve's Policy Committee meeting on Tuesday and Wednesday of this week to discuss raising interest rates again?
That is the million-dollar question.
Right. If the data on Thursday is expected to show inflation dropping, aren't they going to look totally foolish if they hike rates on Wednesday? Like prescribing heavy medication the day before the TEL results come in.
This raises an important question about how central banks are really forced to operate, because they are dealing with a structural lag. By the time the data is collected across the entire country, then verified by the Bureau of Economic Analysis and finally published, the reality on the ground has already shifted.
The world has moved on.
Exactly. But this week, the timing is just agonizing. The Fed has to make a binding decision on Wednesday in a total vacuum of Thursday's official confirmation.
And they are leaning towards raising rates anyway, without seeing the report.
It is a very real possibility, yeah. As of Monday, the CME Group's Fed Watch tool priced in a 38% chance that the Fed would hike rates by a quarter point.
Hold on, let's break that down for a second. What exactly is the Fed Watch tool? Because I hear that thrown around on financial news all the time, but where does that 38% number actually come from? Is it just like a poll of economists?
No, it's much more concrete than a poll. It's based on something called Fed Funds Futures.
Fed Funds Futures. Okay.
So think of the financial markets as a massive prediction engine. Institutional investors use these futures contracts to basically place financial bets, putting literally billions of dollars on the line. Yeah, they're predicting what the Fed will do with interest rates. The Fed Watch tool just takes all that real money trading data and calculates a probability. So when billions of dollars point to a 38% chance of a rate hike, it means the market believes the Fed is still anxious enough about inflation to keep applying pressure even before Thursday's report comes out.
And that pressure affects everyone listening. Like, a rate hike isn't just a spreadsheet update in Washington.
Not at all.
If you're looking at your credit card APR or trying to get a mortgage or financing a new car, that Wednesday decision directly drives up the cost of borrowing money across the entire economy. And the Fed's goal is to wrestle inflation back down to their target of 2%, which is a number we haven't seen since, what, 2021?
Precisely. And here is the truly complicated part. Even if the Fed had Thursday's report in their hands on Wednesday morning, it might not change their minds.
Wait, really? Why not?
Because the good news in that June report, that drop to 3.7%, it comes with a massive, dangerous asterisk.
Oh, because the drop to 3.7% is essentially an illusion.
Yes.
When you look at the specific causes in the source material, it's a trap. Because the June inflation drop is almost entirely attributed to a temporary fall in gasoline prices.
Right.
That's it.
Just cheap gas.
Right. We didn't see some broad structural healing of the U.S. economy.
Yeah.
We just saw cheap gas at the pump.
And we really have to look at why gas was cheap in June. Because it wasn't due to, increased domestic production or a sudden drop in global demand.
No.
It was purely geopolitical. There was a brief pause in the ongoing conflict involving Iran, which basically allowed for a temporary resumption of Middle Eastern oil supplies.
So the global supply chain breathes this sigh of relief for a few weeks. Oil flows freely, the price at the pump drops, and that drags the entire June inflation number down to 3.7%.
Exactly.
But that brings us to July, and July completely erased this progress.
It did.
The pause ended. The U.S. and Iran resumed fighting, and Iran threatened oil flows through two major choke points, the Strait of Hormuz and the Bab el-Mandeb Strait.
And those two straits, they are the critical arteries of the global energy supply. The Bab el-Mandeb Strait, for instance, that's the gateway to the Red Sea and the Suez Canal.
Right.
When military threats emerge there, shipping companies don't just wait it out and hope for the best. They immediately reroute entire fleets of oil tankers down around the Cape of Good Hope at the bottom of Africa.
Which has to take significantly longer.
Oh, it adds 10 to 14 days to a single voyage.
2 extra weeks.
Yeah, 2 extra weeks of burning fuel just to move the ship, paying daily crew wages and tying up cargo capacity so those ships can't make as many trips per year. And all of that logistical friction instantly translates to a higher price per barrel of crude oil on the global market.
And our sources note it wasn't just the Middle East causing this friction, because at the exact same time, Ukraine attacked Russian oil refineries, severely disrupting global fuel supply chains even further.
Right, a totally separate shock.
I have this quote here from David Miracle, the chief U.S. economist at Goldman Sachs, and it highlights this perfectly. He wrote, "The re-escalation of the war with Iran and attacks on Russian oil refineries have pushed energy prices higher and revived fears that the already lengthy series of supply shocks could continue."
It means the baseline cost of moving anything anywhere in the world just went up again.
Here's where it gets really interesting.
Yeah.
Think about the lag time we were discussing earlier. By the time Thursday's report comes out telling the Fed that gas was cheap in June, anyone who has filled up their tank in the last week knows that reality has already vanished.
Right, they can see it at the pump.
So how long does it actually take for a disrupted barrel of oil in the Middle East to hit a local gas pump in the U.S.? What's the delay there?
It can be surprisingly fast, but it happens in stages. Crude oil trades on a global market, right? So the raw material price spikes immediately based on fear and speculation. Just the threat of a disruption moves the market.
Okay, that makes sense.
But physically, that crude still has to be purchased, shipped, refined into gasoline, and then trucked to your local station. That physical lag takes a few weeks.
Right.
However, gas station owners know their next delivery will cost them more, so they often raise prices at the pump immediately to cover their future replacement costs.
So they preemptively hike the price.
Exactly. So the consumer feels the pain of a blockade almost in real time, long before the Bureau of Economic Analysis can document it in a monthly report.
Which exposes this incredible fragility. June's cooling inflation might have made you feel a little better at the grocery store temporarily, but the July energy shock proves how vulnerable our domestic prices are to events happening oceans away. It shows we haven't solved the root causes of inflation at all.
We haven't. And the Federal Reserve is acutely aware of this vulnerability. They know energy prices are notoriously volatile. They know food prices can swing wildly just based on a bad harvest or a geopolitical blockade. That is precisely why policymakers rely on a completely different metric to see what is actually happening underneath all that chaos.
Right, which brings us to core inflation, where economists basically take the inflation data and surgically remove food and energy prices to find the baseline temperature of the domestic economy.
Exactly. When the Fed says they want a 2% inflation target, they really mean a 2% core inflation target. They want to measure the persistent underlying trends of the economy that aren't going to be skewed just because a drone struck an oil refinery somewhere.
So let's look at Thursday's core inflation expectations. It is expected to edge down, but barely. The prediction is a 3.3% annual increase in June, which is down just a tiny fraction from 3.4% in May.
A very modest cooling, yeah,
Okay.
but still significantly above that 2% goal.
But when you read the source material, the top-line number of 3.3% isn't the real story.
Yeah.
The real story is this bizarre tug-of-war happening beneath that number.
Oh, absolutely.
Michael T. Gavin, the chief U.S. economist at Morgan Stanley, he breaks down what is actually rising and falling inside the core index. And he points out that we are actually seeing a real slowdown in services inflation.
Which is usually fantastic news. Services inflation covers the traditional human-centric parts of the economy. Renting an apartment, eating out at a restaurant, booking a hotel room, getting a haircut.
Right, the stuff you do every day.
Exactly. And historically, services inflation is incredibly stubborn. It's hard to cool down because it is so tightly tied to human wages. So when rent and restaurant prices start decelerating, it usually means the Fed's interest rate hikes are actually working to cool off the broader economy.
Right, so rent is cooling down, food services are cooling down. But then Gabin expects this progress to be entirely offset by a massive, unexpected spike in core goods.
Yeah, this is the twist.
And according to the source, this spike isn't because we are suddenly buying too many cars or washing machines. It is being driven specifically by a strong increase in software prices, reflecting intense, ongoing AI-related demand.
What's fascinating here is how the Bureau of Economic Analysis actually constructs the PCE basket to measure this. It required geeking out a bit on their methodology, but it's important.
Let's geek out.
They don't just look at what you, the individual consumer, put in your shopping cart at the store. The index relies on what's called producer price translation.
Producer price translation.
Right. They track what businesses are spending just to operate, because eventually those business costs translate into consumer prices. And in the modern economy, software is no longer categorized as just some minor administrative cost. It is heavily weighted in the core goods basket as foundational capital infrastructure.
I'm really trying to wrap my head around this. Because when I think about inflation, I think about the price of my groceries going up. I don't go to the store and buy enterprise AI software.
No, you don't.
So how does a massive tech corporation buying B2B, business-to-business software actually trickle down into the core inflation metrics that affect me?
Let's make it concrete. Think about a major logistics and shipping company. They decide they need to buy a massive AI-powered software package to route their delivery trucks more efficiently across the country. And they aren't the only ones, right? Every retailer, bank, and media platform is in an absolute arms race right now to integrate artificial intelligence.
Everybody wants it on AI right now.
Exactly. And because of this astronomical demand for AI, the software providers and the cloud computing data centers powering them are raising their prices. It is a classic demand shock. So that logistics company suddenly sees their IT and software bill double.
Wow, okay. And they aren't just going to absorb that loss.
No, they pass it on. Because their operating costs just skyrocketed, they have to raise the price of shipping a package by 50 cents to cover their new AI software overhead.
Oh, I see.
So you, the consumer, you never bought the AI, but you pay for it when you ship a box or buy a product that was shipped via that network. The cost of the software just gets baked into the cost of almost every good and service in the economy.
That completely flips my understanding of technology.
Yep.
Because we are so used to technology being deflationary.
Yes.
Like a smartphone replaces a camera, a GPS, a calendar, a calculator. It makes our lives cheaper and more efficient over time.
Historically, yes, tech drives prices down through efficiency. And eventually, AI might do the exact same thing. But right now, we are in the infrastructure phase.
The building phase.
Right. The race to acquire the software, the servers, and the raw computing power is running so incredibly hot that it is currently highly inflationary.
It is single-handedly propping up core goods inflation.
Yeah.
We have this literal tug-of-war happening. Traditional human services like housing and dining are cooling down on one side of the rope, while artificial intelligence software is violently pulling prices up on the other side.
It's a huge tension.
And the Fed is just standing in the middle trying to referee the match.
And they are trying to referee it using interest rates, which is a remarkably blunt instrument for a highly specific, complex dynamic like an AI arms race.
So what does this all mean? Let's synthesize this whole deep dive for everyone listening. When Thursday rolls around and you see headlines celebrating that inflation dropped in June, you now have the context to read past the top-line number. Yes, the report will look like good news on paper. But that good news is haunted by three massive caveats.
The big ones, yeah.
First, it arrives a day late for the Wednesday Fed rate decision, meaning borrowing costs on your credit cards and mortgages might go up regardless. Second, the drop to 3.7% is largely a mirage based on outdated June gas prices. Prices that were artificially low due to a temporary pause in a Middle Eastern conflict that has already resumed.
And third, underneath the surface, a hidden boom in B2B artificial intelligence software is aggressively inflating the cost of core goods, which is masking the genuine progress we are finally making in cooling down housing and service costs.
If we connect this to the bigger picture, the real takeaway is that you cannot just look at a single data point and assume you understand the health of the economy.
Oh,
You really have to understand the mechanisms underneath.
you do.
You have to understand how a physical shipping blockade in the Red Sea adds 2 weeks of transit time and spikes the cost of oil. You have to understand how a logistics company's expensive new AI software gets baked into the cost of literally everything you buy. The modern economy is a deeply interconnected web, and a headline number like 3.7% barely scratches the surface.
It really requires looking past the symptom to understand the actual disease.
Which leaves me with one final thought. Something that wasn't explicitly stated in the sources, but that feels unavoidable after breaking all of this down today.
What's that?
If the future of our core inflation is increasingly being driven by entirely digital commodities, like the skyrocketing corporate demand for AI software, while our headline inflation is held hostage by physical geopolitical blockades of global oil straits, well, will the Federal Reserve's traditional tool of simply raising interest rates eventually become obsolete?
It's a fascinating dilemma because you really can't interest rate your way out of a naval blockade in the Bab el-Mandeb Strait.
No, you can't. And you might not be able to interest rate your way out of a corporate arms race for artificial intelligence either. So how do we fix an economy when the tools we have were built for a world that no longer exists? Just something to think about the next time you see a simple percentage trying to explain a very complex world. Thanks for joining us on this deep dive.